This video shows how to measure non-controlling interest in the group. Here is Samuel's non-controlling interest in the subsidiary, Michael's subsidiary. There's Samuel having 10% non-controlling interest in that subsidiary. We're going to look at how to prepare consolidated financial statements with the non-controlling interest. The case example that's taken here is on 1st of July 20XO. Michael raised 600 million of share capital, and after receiving that cash, purchased 90% of Samuel's business controlling interest for 500 million. On 1st of July 20X1, that's at the date of acquisition, Michael's subsidiary sold 80 million in inventory costing 60 million to Michael parent. So there's intergroup transaction. Michael parent holds the entire unsold inventory as of 30th June 20X2. So 30th June X2 is 2 years after the acquisition. So the transaction took place in the second year. The investor firm is called Michael parent and the invested firm is called Michael subsidiary. We have received the financial statements for Michael parent and Michael subsidiary on 1st of July 20XO, that's at the date of acquisition, and 30th June 20X2, 2 years after the date of acquisition. The income tax rate is 30% required for the year ending 30th June 20X2. Prepare consolidation journal entries first. Second, calculate Samuel's non-controlling interest at the acquisition date from the acquisition date to beginning of current year and then in the current year. Third, prepare consolidated financial statements. So at the date of acquisition, that's on 1st of July 20XO, Michael parent's financial position shows he raised 600 million of share capital, invested 500 million, and this remaining amount is in cash, 100 million. On that date of acquisition, Michael subsidiary, earlier it was Samuel's business, had 200 million of share capital and 290 million of retained earnings, was represented by land of 406 million. There was inventory of 60 million and there was cash of 24 million. On 30th June 20X2, that's 2 years after, the situation was that there was a sale of inventory for 80 million by subsidiary, Michael subsidiary. The costing was 60 million and made a profit of 20 million, and there was income tax expense of 6 million, and that became income tax payable of 6 million. There's profit after tax of 14 million. There's retained profit that has increased from the date of acquisition. At the date of acquisition, it was 290 million. It has now become the retained profits brought forward is 310 million. So during the past year, the profit has increased by 20 million. The share capital has not changed. It is 200 million. It's represented by land which was previously there, and the cash has increased because the retained profits have increased and it has translated into cash. The net asset position of the Michael subsidiary is 524 million, for the Michael parent it is 600 million. Let's now look at the consolidation journal entries. Because the assets are stated at fair value of the subsidiary, so therefore we don't need to do any fair value adjustments for the subsidiary. So we can start with the elimination of investment against fair value of Michael subsidiary. And it's 90% interest that Michael acquired in previously Samuel's business and now Michael's subsidiary is 200 million, 90% interest, and there's retained earnings, and the retained earnings was 290 million. 90% interest was acquired, and the investment was 500 million. It's more than the fair value of net assets. There is an asset which is not shown on the balance sheet on the subsidiary, and that's goodwill on consolidation of 59 million. The next transaction was on trading inventory, subsidiary selling inventory to parent. So it was sold at 80 million. So we need to eliminate the trading transaction. So we debit sales and credit cost of sales. Then we need to eliminate the unrealized gain on sale of inventory. So we debit 20 million to decrease the gain to cost of sales, and we credit inventory 20 million to decrease the overvalued inventory because of the sale that included unrealized gain. This results in the tax effect of it. We increase the expenses, and that decreases the profits. And when it decreases the profit, applying the tax rate, it decreases the income tax expense, and the income tax expense decreases, and we credit income tax expense 6 million. Although the inventory has been sold previously, it is for the group, it has not been sold. So therefore, this income tax expense is not realized. So therefore, we need to defer that income tax expense, and we defer that income tax expense by debiting deferred tax expense, because income tax expense will realize only for the group when it is sold outside the group. In the group financial statement, we can see that there's Michael parent and Michael subsidiary. Michael parent, there's share capital of 600 million and the investment of 500 million. They bought inventory of 80 million in this year, that's 30th June 20x2, in the current year. And there's cash that is remaining, which is 20 million. For Michael's subsidiary, it sold inventory for 80 million. The cost of inventory was 60 million, made a profit of 20 million. And there's income tax expense resulting from that is 6 million. And that has become income tax payable 6 million. And there's profit after tax of 14 million. There's the previous profits or earnings that's been brought forward is 310 million, and share capital has not changed, 200 million, and shareholders' equity is 424 million. On Michael's subsidiary, the land is still there. It is intact, and the cash has increased because the profits have translated into cash. We can now enter the consolidation journal entries. So we start with elimination of investment of 500 million against the 90% controlling interest of Michael parent in Michael subsidiary. Share capital and retained earnings, 180 million share capital and 261 retained earnings. And then there's goodwill on consolidation of 59 million. Our next entry was for the inventories. The first is the trading transaction. We eliminate by debiting revenue and crediting cost of sales, 80 million each. Then we need to eliminate the gain on sale of inventory, that was 20 million. So we debit cost of sales of 20 million and we credit the inventory to decrease overvaluation, 20 million. Because of this, there is tax effect and there's tax application because cost of sales increase and income tax expense decrease, that's 6 million party. Therefore, this income tax expense has to be deferred until the inventory is sold by the group to outside party and earn profits. So those are the entries. Once we have entered those entries, we can see that there's revenue is zero, cost of sales is zero because the intergroup transactions profit is zero. That's the only transaction that has taken place in the subsidiary. Michael parent has been dormant without any transaction, and therefore the group situation is that it has not made any profit. And the retained profit that's shown here is the profit that has been earned up to previous period, that is after the acquisition, post acquisition, and that's in the previous period. What was earned by the group is 49 million. Share capital of the subsidiary, 180 million has been eliminated. What's remaining is 600 million of Michael parents share capital plus 200 million into 10%, that is Samuel's non-controlling interest in the share capital, and that's 620 million. And there is goodwill on consolidation, there's land, there is deferred tax asset as resulting from the consolidation journal entries. There is inventory original value of 60 million, and there is income tax payable of 6 million. So it is this income tax payable that is now corresponding with the deferred tax asset. The cash situation has increased. So net asset situation in the group is 669 million. We can now look at assigning non-controlling interest to Samuel. When we assign the non-controlling interest to Samuel, we start with the Michael subsidiary. And from the Michael subsidiary, that's where the non-controlling interest is located. That's where Samuel is. And we need to adjust for the intragroup transaction because this shareholders' equity situation changes because of the intergroup transaction. It changes for Samuel by that non-controlling interest amount only. That's 10% of those the intergroup transactions. Now there are two streams of thoughts. Which intergroup transaction should we consider for non-controlling interest? One stream of thought is that anything that's affecting the Michael subsidiaries' shareholders' equity. So there could be a transaction that has been initiated by the parent and it is going to affect Michael subsidiary. For example, there's inventory that has been sold to subsidiary from the parent, and then the inventory is an asset and parent would have made a profit in the previous year. But if the inventory was not sold in the previous year, and then it is going to get sold in the current year, then that inventory would go into become cost of sales in the subsidiary. So therefore, the profit situation can change in the subsidiary. So shareholders' equity situation can change in the subsidiary. So that can then affect the Samuel's non-controlling interest. So that's one stream of thought. The other stream of thought is we just consider only transaction that has been initiated by Michael subsidiary, and those transactions, if they are affecting the shareholders' equity of the subsidiary, and then they are considered and others disregarded. For this presentation, I'm taking the second stream of thought, that is the intragroup transaction that has been initiated by the subsidiary, and then there is unrealized gain, or there's some impact on the shareholders' equity of the subsidiary. Then that's going to affect the non-controlling interest, that is Samuel, in the subsidiary in this instance. So let's look at assigning non-controlling interest to Samuel, or the non-controlling interest. It's assigned in 3 phases. The first is at the date of acquisition. At the date of acquisition, we can see the share capital and retained earnings of 200 million and 290 million, and 10% should be assigned to Samuel, non-controlling interest. And if this the non-controlling interest is measured at the net assets value, so making that assumption here net assets value, and therefore we don't need to adjust for the goodwill to assign a portion of that goodwill to non-controlling interest. So that assumption, underlying assumption, is there, and on that basis non-controlling interest is 49 million. Then the second phase is where the increase in retained earnings or shareholders' equity, for that matter, from the date of acquisition to the beginning of the current period. From that, non-controlling interest portion is assigned, and here the increase is from 290 to 310, and that increase is 20 million, and the non-controlling interest is 2 million, and therefore we assign 2 million to non-controlling interest. And the third is allocating non-controlling interest for the current period retained earnings. Our retained earnings for the current period is 14 million. That's the retained earnings. So we start with that 14 million. We start with 14 million. That's 14 million here. And then there is unrealized gain on sale of inventory of 20 million that decreases the profit, current period profit for the group, and there's decrease in income tax expense because of that, the tax effect of that, and that's 6 million credit. And when we add up, is a credit and debits are equal to 20 million. So therefore, there's no profit that's been made in the current period to be assigned to non-controlling interest, because we realized that it was the only transaction that subsidiary has entered is an intergroup transaction, and that intragroup transaction got eliminated. And because it got eliminated. The profit that was earned got eliminated by eliminating the unrealized gain along with the tax effect of that. So let's look at the presentation of financial statements. We present in financial statement the micro-parent, parent financial statement, and along with that the group financial statement. The reason for presenting them is the parent that's controlling the group, the other members in the group. So is the parent that's taking the initiative and is responsible to prepare group financial statement. So therefore the parent financial statements are shown and in the group financial statement. In the parent financial statement, there's no non-controlling interest. But in this instance, the income statement, because parent has been dormant, there's no profit that parent has made. Group, there was an intergroup transaction, but apart from that, there was nothing. So group has not made a profit. So therefore, there's nothing to assign to non-controlling interest in the income statement. But we need to show the amounts that's assigned to controlling interest and non-controlling interest after showing the total comprehensive income. Then the financial position, also we need to show the total the shareholders' equity of micro-parent and the group. Here the micro-parent is 600 million, there's no non-controlling interest, and the total equity is 600 million. And micro-parent, it was 549 million, and of which there was 51 million of non-controlling interest, because at the date of acquisition there was 49 million that was assigned to non-controlling interest, and from the date of acquisition to the beginning of the current period it was 2 million assigned. Together is 51 million, but in the current period there was no profit that was made to be assigned to non-controlling interest. So when we add up 549 and 51, that gives us the total equity of 600 million. So that brings us to the end of the video. Thanks for watching.